Welcome to Principles of Macroeconomics. Lecture 9 will focus on fiscal policy and tools that we can use for macroeconomic stabilization. First, we should take a look at Keynesian economics. Keynesians believe that changes in output, rather than changes in price levels, direct the economy toward an equilibrium, or a point of balance. During the Great Depression, consumers were unwilling to spend much because reductions in stock market prices and the value of other assets had reduced their wealth and their incomes. Keynesian economists spend much of their time thinking about aggregate demand when it comes to macroeconomic stabilization policies and moving the economy toward its maximum potential output. So what we have to look at now is the multiplier principle, which is important to Keynesian and even New Keynesian economics. And this is a concept that an increase in spending on a project, usually a government finance project, will generate income for the resource suppliers, who will then increase their consumption spending. As successive rounds of spending occur, total income will expand by a multiple of the initial increase in spending. So if you have a construction project to build a bridge, not only do you have to buy materials and pay workers, but then those workers will turn around and spend money elsewhere in the economy, and it will continue to multiply. So they use an expenditure multiplier, and this is simply the ratio of the change in equilibrium output to the independent change in either investment, consumption, or government spending, which brought about that change. It is equal to 1 divided by 1 minus MPC. And MPC is a marginal propensity to consume. That is, if you get an additional dollar, what is the percentage of that dollar in income that you will turn around and spend on consumption? So MPC is equal to the additional consumption divided by additional income. Keynesians have a very unique view of fiscal policy, which is government policies involving taxation and government expenditures. Keynesians argue that the federal budget should be used to promote a level of total spending which is consistent with the full employment rate of output. That is, during times of recession, expansionary fiscal policy can be used to increase aggregate expenditures. This is referred to as expansionary fiscal policy. However, during times of rapid economic growth in our business cycle, the federal government should decrease spending and increase taxes to achieve a balanced budget. This is known as restrictive fiscal policy. So rather than advocating a balanced budget policy, Keynesians supported countercyclical policy, which is a policy that tends to move the economy in an opposite direction from the forces of the business cycle, which tend to be highly volatile. This should smooth out economic fluctuations and reduce the boom and bust cycle present in the economy. We can explain the Keynesian view by using the Keynesian aggregate expenditure model. And we can analyze this with the framework we developed in our aggregate supply, aggregate demand model from our previous lectures. The aggregate expenditure function will be important to solve for the new Keynesian equilibrium. In the model below, we have aggregate expenditures, which is the red line, and this is equal to consumption plus investment plus government spending, and if we want to use an international macroeconomic model, we would also include net exports. And this tells us for each level of actual output, or national income, how much planned expenditure is happening in the economy. So the x-axis in our model represents actual output, but the y-axis represents planned aggregate expenditures. So if we fall at a point below the equilibrium, which the equilibrium is determined using a 45-degree angle line. The 45-degree angle line shows us all points at which actual output where income equals planned expenditures. So anytime our red aggregate expenditure function does not cross this 45-degree angle line, we are out of equilibrium. If we fall to the left of this equilibrium point, we're having more expenditures than we're actually producing in national output. This will cause business inventories to decrease, and it will provide the incentive for them to increase production. However, if we fall to a point on the red aggregate expenditure line to the right of this equilibrium, we will see an increase in the business inventories because we will be consuming less in planned expenditures than we're actually producing. This will force businesses to reduce production and move the economy back into equilibrium. So we should ask, how do we achieve full employment from this Keynesian economics perspective? Well, if the equilibrium output solved in the previous model is below an economy's potential output, then increasing government expenditures should shift the aggregate expenditure function upward. That is because government expenditures are included in the aggregate expenditure function. This will result in a higher equilibrium level of output. If aggregate expenditures are too high, however, reductions in government spending or increasing taxes will reduce the equilibrium back to the economy's potential level of output. Now that we understand a little bit of a background on Keynesian economics, we should also take a look at the other side of fiscal policy, analyzing the incentives and secondary effects of government intervention into the market system. Although Keynesian economics was popular at one point in time, most economists disagree with the simple old Keynesian model, and we need to examine the effects of fiscal policy in terms of the incentives for individual actors and the secondary effects. One important concept when analyzing these secondary effects is called crowding out. Crowding out is when we have a reduction in private spending as a result of higher interest rates generated by budget deficits that are financed by borrowing in the private loanable funds market. This is a secondary effect of the Keynesian policy of running a budget deficit to increase total output, but ultimately it reduces consumption spending and crowds out investment spending, leading to a smaller multiplier effect than we previously believed. Continuing the principle of crowding out, the multiplier effect from increasing government expenditures is really less than that equation where 1 divided by 1 minus MPC gave us the expenditure multiplier, as increased government borrowing to finance their deficit reduces private consumption and business investment in capital, in buildings and inventories. So as private business investment is reduced, the output of capital goods will decline. As a result, the future stock of capital available to future workers will actually be smaller than it would otherwise have been, and this will reduce future worker productivity and may reduce long-run economic growth. So if the Keynesian model has some problems, we should take a look at some alternative scenarios or alternative theories about macroeconomic policy. In this section we will cover fiscal policy, future taxes, and a new classical model, also known as the neoclassical model of economics. So, new classical economists are economists who believe that there are strong forces which will push an economy toward full employment equilibrium, and that government macroeconomic policy is largely an ineffective tool with which to reduce economic instability. One of their main tenets is the Ricardian equivalence theorem. This is the view that a reduction in taxes, which is financed with government debt, will have no effect on current consumption and aggregate demand because people will recognize that if the government's increasing their debt, they will have to finance this additional government national debt with higher future taxes. And economic actors in an intertemporal model will anticipate the higher taxes and begin saving for it. When these households increase their savings, they will have to reduce consumptions in the present period. Even though we have some areas of disagreement in terms of fiscal policy between the Keynesian economists and a neoclassical economist, there are three main areas of agreement about fiscal policy. So we should note the tenets on which these macroeconomists largely agree. First, the proper timing of discretionary fiscal policy is both difficult to achieve and crucially important, because many of the decisions regarding fiscal policy are made in the political arena. They cannot quickly respond to the economic needs of the market. So you may have a recession, but in the meantime, market forces may move the economy back to full employment equilibrium. At the time when you introduce a stimulus or expansionary fiscal policy, it may throw the economy out of balance. Secondly, automatic stabilizers such as income taxes or sales taxes reduce fluctuations in aggregate demand and help direct the economy toward full employment, as we covered in the previous lecture. And finally, fiscal policy is much less potent than the earlier Keynesian view implied as a result of the crowding out theory and the idea that individual actors will anticipate higher future taxes and therefore won't increase their consumption in the present period. Since we spent much of our time looking at the Keynesian view of economics, we should see some non-Keynesian critiques. First, the non-Keynesians would argue that the expansion in government debt will mean higher future interest payments and higher future tax rates. This will retard long-term economic growth. Secondly, recessions really reflect a coordination problem related to the composition of aggregate demand. It's really a coordination problem between individual actors. It's not just a result of an overall lower level of aggregate demand. Increasing government spending is likely to increase the severity of this coordination problem rather than reduce the recession. And thirdly, more politically directed spending will lead to more rent-seeking and less wealth-creating production. The two views of macroeconomics that we have just analyzed, that is the Keynesian view of economics and a neoclassical view of economics, are really focused on making up short-term fluctuations or alleviating short-term fluctuations which bring the economy away from full employment and full potential output. But there's another branch of economics which deals with long-term growth, and this is known as supply-side economics. Supply-side economists are economists who believe that changes in marginal tax rates exert important effects on aggregate supply. On the demand side, lower taxes increase consumers' after-tax incomes and thereby stimulate consumption and aggregate demand. But more importantly, for supply-side economists, lower tax rates increase the incentive of people to work, so the marginal benefit of one more hour increases, therefore people will tend to work more and take less leisure time. So they will supply more resources and use them more efficiently. This will increase aggregate supply in the short run. This effect will take time to be noticed, and supply-side economics is a long-run, growth-oriented strategy, not a short-run stabilization tool. So using both the demand side and the short-run aggregate supply, these two functions will shift out over time, and eventually we will have a rightward shift of long-run aggregate supply. Finally, we should take a look at why tax rates reduce total output. First, high marginal tax rates discourage work effort and productivity. When marginal tax rates soar to 55 or 60%, people get to keep less than half of what they earn, so they will tend to work less. Second, high tax rates will adversely affect the rate of capital formation and the efficiency of its use. This is because we are altering the benefits associated with increasing capital investments. Third, high marginal tax rates encourage people to substitute less desired tax-deductible goods for more desired non-deductible goods. That is, differences in tax rates will cause people to make different consumption decisions and distort the marginal valuations of goods and services within the economy.